TheoTrade. This is Don Kaufman, June 23rd, 2021. Just about 24 minutes to go to the cash close here with the marketplace. Well, massively unchanged once again. I mean, it's been an absolute slop fest of a trading session, and it's all because, well, we're an expected move slop fest, which I'm going to explain here momentarily. You have, the vast amount of products in the marketplace, major index products, just sitting in and around the edge of their expected move. And that's where, for the most part, risk goes to die. Well, everybody's kind of happy. There's not a lot of risk out there. So what do? We slop around a particular level. Let's get to work and actually explain this a little bit in this evening's video. So in terms of the S&P futures, when I say this is absolutely nothing here, look, again, you got 20 some odd minutes left to the close, and the futures right now doing 752,000 contracts. That is incredibly anemic volume. If you compare this trading session to any other recent trading session, well, you have to actually go back to a holiday trading session to actually see this light of volume. Now, I thought that was kind of entertaining to say the least, and that's indicative once again of there's no hedging activity right now. Okay, volume in the S&Ps is very often indicative again of hedging activity. Without volume in the S&Ps, what does it say? Nobody cares. Nobody is necessarily hedging right now, which once again brings me to the point. What are you looking at? An expected move slop fest of a marketplace. Let's start over in the SPX, the mother of all products. So when I talk about an expected move slop fest, first and foremost, let's kind of review and kind of denote exactly what the expected move happens to be. So on any given day or any given week, you can always tune over to the SPX, or really any product for that matter, and you can open up, for instance, there's a Wednesday expiration, and here we are on a Wednesday, and with again 20 minutes to go to the close, the expected move is some $4.81. All that really pertains to is now, between right now and the close today, all right, and that's the cash close, you're only looking at about a $5 move higher or lower. And you go, well, how can you even justify that? Well, it has to do with the option pricing. I mean, what that $5 move is, yeah, it's an equation, but it's really giving you almost like a temperature of what the market risk is right here, right now. And then, of course, close up the Wednesday because that one's extraordinarily short term. It has 20 minutes left to live. Open up, for instance, the Friday expiration. What do you got? You got about a $30 expected move, which is also inherently low. Okay, but there's one expected move, okay, and only one expected move that we use each week that is static, all right? So most of the expected moves that you're looking at on a day-to-day basis, and this is like the critical aspect, is not just being able to interpret expected move, because I think pretty much anybody can get that, right? So you can just come over here and you can look and go, okay, man, I get what he's saying. We're supposed to move up or down about $30, and that expected move has about a 68% probability associated with it. And that's all fine and dandy, okay? But there's one expected move that's of critical importance. And that's actually what I kind of call the weekly expected move, or our Friday to Friday expected move. So, all right, so let's head over to Think Back. What is Think Back? It's end of day. Again, end of day data. And the reason that we use Think Back is, again, it's not for back testing and so forth. I just use it to display, well, aspects like expected move to give you a better understanding. So I've gone ahead and I've actually backed up the date in this particular context here to June 19th, which is a Saturday, by the way. June 19th happened to be a Saturday. It takes us then back to where the marketplace closed on Friday. So what's so important about the Friday close and every Friday close? Okay, that's where we want to be able to grab the expected move calculation from. Why? Because major trading firms, okay, have tendency to actually pick up huge amounts of risk on a Friday and push that risk to the following Friday. So in effect, the single most important expected move on your screen, okay, to give you an example, would be right here. Okay, and you're like, well, why are you going to the June 25th? Because it's any given Friday, and on a Friday, you'd want to use the PM settlement. You can see the expected move was $90.29. So roughly plus or minus 90 equals the expected, all right, move of a given week. Now, that again, it's going to be static. It's not going to change. And that is the number that I will take and actually place specifically on the charts. Why do I put it on the charts? Because listen, I'm a much more quantitative trader. Like I get, exactly when, and I watch order flow, and I know when they're actually going to roll positions from one expiration into the other. And I've, through huge amount of data sets, we've been able to actually look and say like, all right, the Friday expiration is unequivocally the most important expiration, but that plus or minus 90, again, like you can't think of this as some like random like calculation, a random number. What it really is an average of all the option pricing that was traded on Friday. Okay. And you can see this thing, it doesn't just hold weight. It holds tremendous weight. Now, the single most important expected move is unequivocally in the SPX because it's the mother of all products. Billions of dollars are traded there. If you want to see this in real, kind of real time and real action, what you're actually seeing is we hit the upper edge of the expected move. Now, I do not want you to think of as expected move as support and resistance. Okay, this right here, that line, that's the happy place. It literally is the happy place. Why is the happy place? Because it's the happy place. It's where buyers meet sellers. If you looked at this, and again, I want to put this in like context because when I talk about like an expected move slop fest, it throws people a little bit. And I'm telling you, this might be one of those evening videos you might want to watch like 3 or 4 times. But what's going on is there are traders that are out there selling. Okay. And they are selling tons of options. They're selling calls, they're selling puts. And why are they selling so many? Because you're a retail client and you're buying. So you have these buyers, okay, and you have sellers. And the interesting thing is, right, the average between the buyers and sellers meet at the edge of the expected move. That's really what the expected move happens to be. So for example, if you went out on Friday, okay, and you sold 10,000 straddles, okay, your whole risk scheme is actually based on the edge of the expected move. So you imagine a trading firm that's trading tens of thousands of different option contracts in the SPX. And in effect, okay, most of their risk sits on the edge of the expected move. Now, you don't know whether those trading firms are buyers or sellers. It doesn't matter. All you know is the edge of that expected move. The edge of that expected move. That's where the buyers and sellers meet. And it's like a seam inside of risk. So when I talk about like an expected move slop fest, what you're seeing is this is where risk goes to just chill. That's it. I mean, risk goes right there to chill. Now, let's take it a little further than the SPX. Okay, we can apply this to the QQQ. What does the QQQ think about it? The QQQ, you're like, Don, you don't have an expected move. No, that's where I hit auto expected move. Okay, take a look where the Qs are. They did the same thing. They clipped the upper edge of the expected move, pulled in. What else you got? I don't know. Let's look at some of the other major products. All right. So tech, obviously. Let's go look at the financials. Where are the financials right now after getting slammed? And sometimes, hey, we do break expected move, right? But expected move, again, it's where risk goes to kind of die. And you'll see, there you go, XLF sitting right on the edge of the expected move. Go look at a couple of products out there. Microsoft, oh, it's just a hop, skip, and a jump outside the expected move. And you look at something like Apple, okay, where is it? It's literally pretty much on the edge of the expected move. Here's an interesting irony. Take a look at the bonds, the TLT. All right, TLT, where is it? Ooh, yeah, it's at the lower edge of the expected move. Like people, everything that's going on in today's marketplace. That's why, I started this video like, hey, it's a slop fest, but more appropriately, it's an expected move slop fest. And you gotta, again, you can't just sit buy idle and not look at these particular levels because it doesn't matter right now. It doesn't matter whether you're bullish, whether you're bearish, you're a buyer or seller. I don't care whether you trade stocks, options, and futures. People, expected move is where it's at. The marketplace, right, is looking for this $90 move. And it got every ounce of the $90 move. Now it's sitting there, okay, and it's waiting now for another catalyst. And I'll tell you what, it actually needs another catalyst. Why does it need another catalyst? Because it literally gets stuck in this zone where it's kind of the happy place where risk goes to die because there's much less risk here. This is where buyers and sellers just subside and they say, well, I don't really need to hedge. Why don't you need to hedge? Because it's where the buyer and seller effectively meets. Now, the second, like for example, if we started to sell off, we just got 12 minutes to go to the cash close. We started to sell off here a little bit. All of a sudden, okay, gamma risk is going to kick back on and we're actually going to start flying to the downside. Or I'll get controversial for a second. If we started to rally a little bit, it would kick on and actually start to rip us outside of it. All right. And that's what I'm going to say. It is a binary level, like to try to evaluate it. We're going higher or lower from here. I'll tell you what, the highest probability by the end of the week is that you're inside the expected move. Again, the highest probability by the end of any given week is going to be inside the expected move. Nevertheless, you're in a dangerous position when you're on the edge of the expected move, because if we do break outside of it, the marketplace can actually springboard and actually explode higher off of it as hedging activity once kind of kicks in. So with that, what do you expect? Well, the rest of the week, look for catalysts. Anything that's actually going to scare this marketplace off the edge of the expected move. Because right now, there isn't per se a field to trade. Like when I say there's no field to trade, you're looking at like what? A 50-50 advanced decline line? Every major product is sitting on the edge of the expected move. The bonds, okay? The bonds, yeah, they've sold off a little bit this week. They're actually on the lower edge of the expected move, like the marketplace is on the upper edge of the expected move. Nevertheless, okay, there's not a feel for it. You want to look at the expected move, okay, and anticipate as we start to push off the edge of the expected move, whether that be higher and or lower. Thanks everybody for watching us here at TheoTrade. Have a wonderful evening. Bye-bye.